Now let us understand what is family pension. Hey, sometimes the employee works for the organization and in between he dies. That means he did not retire, but he died during the employment only. Or sometimes what happens, he retired, he was getting pension, and after that he died. And as per the terms of employment, after his death, the family member, maybe his wife, the widow, or maybe his children, will get the family pension. So normal pension is given to the employee, but in case of employee's death, his family receives the pension, and that is family pension. Now normal pension is taxable under the head salary because employer-employee relationship is there. But this family pension, the family member is not employee, so it cannot be taxed under salary. So it is taxed under income from other sources. Now it is taxable, but some relief should be given, right? It is the toughest times which the family is going through. The earning person died. So government said no problem, we'll give some relief. So what government said, whatever family pension received minus minimum of the following. Right? What is that? 1/3 of family pension. And second one, fixed 15,000 rupees. Out of these two, whichever is lower, that is minimum, will be deducted from the family pension received. And then balance will be taxable. Suppose example, the family is receiving 30,000 rupees pension. So 30,000 rupees into 12 months. So 3,60,000. So this is family pension received. Less minimum of the following. 1/3 of family pension. That 3,60,000 into 1/3. How much it will come to? 1,20,000. Correct? And second one, 15,000 fixed. So now you will get either 1,20,000 or 15,000, whichever is lower as deduction. So you will get 15,000 as deduction. Now what is the pension received? 3,60,000. From that how much should be deducted? 15,000. How much will come? 3,45,000 will be taxable family pension. Simply this way you should solve the problem. Okay. Now if you are confused with numbers, you just go back and little 1 minute, 2 minutes and listen again and write down whatever I said. Hey, similar problem will do, don't worry. Now come to the next part. Suppose the family receives a commuted amount, lump sum pension, or lump sum gratuity amount, or lump sum some amount like leave encashment about the employee, right? Or they may receive ex gratia payments, but this ex gratia is out of gratitude, out of thankfulness, correct? So it should be paid either by central government or by state government or by local authority or any other government. Then only it is exempt. So what I am telling you, listen carefully. So any lump sum amount received by family is mostly not taxable, right? Any lump sum amount received by family from the employer is not taxable, whether it is gratuity, whether it is leave encashment, whether it is commuted pension, not taxable. But the point is, the employee should have been dead before the date of retirement. Okay? And only in case of ex gratia payments, the lump sum amount is not taxable if it is paid by the central government, state government or local authority. If ex gratia payment is made by other than governments, then it is taxable. This is about lump sum. And what we discussed first is about monthly pension. So what will we do with monthly pension? Again recapping for you. Simply take monthly pension minus minimum of the following. 1 by 3 of monthly pension, that is per annum, or 15,000, whichever is lower. That's it. So clear? Shall we do one problem? Now here in the question, Sundar died on 31st July 2022. Hey, when he died? 31st July 2022. While being in central government service, in terms of rules governing his service, his widow, Mrs. Sundar, is paid a family pension of rupees 10,000 per month and dearness allowance 40%. So 10,000 is basic pay and 40% DA means 4,000. 10,000 into 40%, 4,000. So totally 14,000 is paid. Right? State whether the amount of family pension is accessible in her hands. This is monthly pension, right? So it is taxable. Suppose it would have been lump sum, not taxable. This is monthly, so taxable. Okay? Whether it is accessible, yes, it is taxable. And if so, under what head of income? Is it income from salary or income from other sources? It is income from other sources. Why? No employer-employee relation. The family member is not employee. That's why it's not taxable under salary. So family pension is taxed under other sources. So can she claim any relief deduction on such receipt? Of course she can claim deduction under section 57. Compute taxable income for the assessment year 2023-24, and they also asked us to calculate tax thereof. Very easy, right? Let's start with the solution. Hey, she has any other source of income? She has any other source of income? We don't know actually, because the question did not tell. And when the question did not tell, we'll believe that there is no other source of income. So whatever her income is, the pension. Okay. Chalo, let's start the solution. Computation of gross total income. Computation of gross total income of Miss Sundar. Computation of gross total income of Miss Sundar. Mrs. Sundar is right. For the assessment year 23-24. For the assessment year 23-24. Write down particulars, details, amount. Particulars, details, amount. Okay, very good. Now, in particulars, which head? Salary? No. House property? No. PGP capital gains? No. It is income from other sources. So, we'll write that heading. Income from other sources. Why we are writing it here? Generally, we don't write. But because it is asked in the question under which head. So, to show, we are writing. So, write down income from other sources. Okay. Now, how much she received, that we'll write. Family pension. Family pension. 10,000 basic and 4,000 DA. Arey yaar, 40% of 10,000, 4,000. Okay. 10,000, 4,000 into how many months? Now that employee Sundar died on July 31st, correct? So from 1st August she will get. So August 1st 2022 till 31st March 2023. So August, September, October, November, December, 5 months. January, February, March, 8 months, correct? So into 8 we'll write 10,000 plus 4,000 into 8. Right? We'll get something called as 1,12,000 rupees. So 14,000 into 8, 1,12,000 rupees. Now from this we should deduct, correct? So less standard deduction being minimum of the following. Less standard deduction being minimum of the following. In that, let us write down 1. I said na 1/3 of the pension, I said or not? 1/3 of the pension. Now we'll put in bracket the calculation for your reference only. Okay, 1,12,000 into 1/3. In particulars only we'll write 1,12,000 into 1/3. Okay. Now what is the result? 37,333. 37,333. We'll put in details column. Okay. Okay. Let us write down B. Statutory limit. Now 15,000 is fixed, right? That we'll write. B, statutory limit 15,000. Now tell me 37,333 or 15,000, whichever is lower. 15,000 is lower. So write down 15,000 in amount column. Tell me 1,12,000 is your pension. From that 15,000 should be deducted. So what will you get? 97,000 is your taxable income. Now I can use the word taxable pension also. But why I am using taxable income? Because there is no other income, right? And on this we should also compute tax. So that's why taxable income. How much? 97,000. Now you tell me she has no other source of income and up to 2,50,000 anyhow tax is nil. So what will be her tax? Nothing, nil. So write down tax on above, nil. Tax on above, nil. So this way we should solve the problem. And never ever forget that we should write the notes when we solve the problem. Students do write answers and don't get marks because they don't write the working notes, explanation for the same. So let us write down one working note which is required. Note: it is assumed that other incomes of Mrs. Sundar is nil. Other incomes of Mrs. Sundar is nil. Other incomes of Mrs. Sundar is nil. This way you should solve the problem. Okay, tata, bye bye.